Question 31, which of the following most appropriately measures the length of time it takes to convert a firm's cash into inventory and back into cash in the form of collections from inventory sales? So you've got A, sales cycle. We can rule that out right off the bat. Sales cycle is just telling us how long it takes us to sell the inventory to a customer or client, not necessarily get that into cash. That's going to involve accounts receivable into the equation. B, operating cycle. So operating cycle is going to be the sales cycle plus accounts receivable cycle, or number of days receivable. And this is going to describe exactly what we're looking for. So how long does it take us to sell our product and then get the cash for that? Operating cycle is likely what we're looking for here. And then C, net operating cycle. So we can rule that out. And basically this builds upon operating cycle, but then adds in accounts payable. So how quickly or we're paying our suppliers, that's going to kind of affect the cash going in or out. But that's not included in what we're looking at here. We're looking at just kind of when do we get back into that cash, which would be answer B. Question 32, White Steel Co. is the market leader in the steel industry in Malaysia. White Steel has introduced many innovative products which have successfully penetrated the market time and time again. Compared to the industry, White Steel Co. has a shorter cash conversion cycle, as shown in the following table. So we've got the steel industry at large, and we have some different operating metrics here. So days of inventory, days of receivable, days payable, operating cycle, and then cash conversion cycle. So it says they have shorter cash conversion, which we can see at 80 versus 88. Which of the following is the most appropriate justification for White's shorter cash conversion cycle? A, White Steel's inventory is obsolete. So for this, we'll want to look at days of inventory here. So the industry has 35 days and White Steel has 39 days of inventory. So since they have a shorter inventory cycle, it's actually they would be less likely to have obsolete inventory, since inventory typically goes obsolete based on the amount of time that's passing. So if they had inventories of 90 days and steel industry had 55 days, then that inventory would potentially be obsolete. But since it's faster, we can probably go ahead and rule out A. B, White Steel has tighter terms with its debtors. So debtors meaning the people that owe them money. So we would be looking at days of receivables for this, since the people that owe us money are our customers that have bought inventory but haven't paid yet. So steel industry, the industry average is 93 days, whereas White Steel's is 111. So tighter terms would mean they have a shorter days receivable. So they actually have looser terms with their debtors. They're allowing their debtors to pay over a longer time period. If they were tighter, then they would require a shorter payment period than the rest of the industry. So we should be going with C, but let's make sure it makes sense. White Steel's payment terms are unfavorable for its creditors. So for this one, we're going to be looking at days payable. And so for the steel industry, it's 60 days. So essentially they are their suppliers, they generally pay their suppliers within 60 days, let's say, or that's the average for days payable. Whereas White Steel gets a longer time period of 70 days. And so this would be an appropriate justification. The payment terms are more unfavorable for its creditors than the industry. So this would justify the shorter cash conversion cycle. Answer C. And the reason this makes the cash conversion cycle shorter is because we're adding these 2 days together to get this operating cycle, and then we're subtracting out days payable. Since this is money we're paying out, if we have a longer time to pay it, it's not going out as quickly, so that makes our cash conversion cycle better. So again, we'll go with answer C. Question 33. A company's executive is selecting a liquidity source that it can use without affecting its normal operations. The executive will most likely A, utilize cash in the company's bank account. This sounds like a good source of liquidity to not affect normal operations. They already have the cash on hand, so they don't have to go out and get any credit or change anything. They're just kind of using cash in the bank. So this sounds like a good answer so far. I'm going to circle it for now. B, negotiate a debt contract on behalf of the firm. This sounds like a more onerous task that could affect normal operations if they're having to restructure some debt. It could constrain cash flow available to the firm. So I think we can rule that out as answer A being better. And then C, file for bankruptcy protection and reorganization. This sounds like it's going to be even more onerous and definitely will have an effect on operations if they're filing for bankruptcy. So we'll go ahead and rule that out as well and go with A, utilize the cash. Question 34. Which of the following is least likely a method for a private company to go public? So we're looking at least likely here. So 2 of these will be methods for private to public, and then 1 will not. So we've got A, direct listing. We can rule that out since this is one way that private companies go public. Essentially, in a direct listing, they're not raising any new capital. As the private company is not raising any new capital, it's just giving the shareholders liquidity, so they're able to sell their current shares to the public and be traded on the exchanges, essentially. B, leveraged buyouts. So this is a way that normally a public company would get taken private. So a private equity firm might come in, they'll get a bunch of leverage and buy all the stock of the company and take it private. So B sounds like it's going to be our answer since that's normally a public to private method, not private to public. And then C, IPO. This is the most widely known way, I'm sure, for private companies to go public. In this instance, it's different from a direct listing in that they're actually selling new shares to the public and raising more capital. So we'll go with answer B. Question 35. Which of the following is least likely a step of the capital allocation process? So we've got least likely. So 2 of these will be steps in capital allocation and 1 will not. And capital allocation in this context is relating to corporate finance function. So how does a company allocate its capital? This is not allocation in the context of portfolio management. So we've got A, idea generation. We'll rule this out since, yes, this is a step of the capital allocation process. It's typically the first step. We need to have ideas or views of where we can take our retained earnings or cash that we made and where we can allocate that to make more money. B, replacement project. This sounds like it could be our answer. Capital allocation is typically going to be where we put money to work kind of in new ways, whereas a replacement project is going to be replacing existing assets. And so if we are in a if we're in a manufacturing business, maybe it's kind of replacing some certain machine that's helping us continue to create current production. Whereas capital allocation, where that's going to differ is where maybe we invest more dollars into a new type of machine that helps us create more widgets or whatever else it is. So I think we could lean towards B for now as our answer. And then C, capital allocation planning. We can rule out since it's also going to be part of the process. And I think when you're looking at it, it's the third step in the steps that the CFA curriculum lines out. But it's kind of organizing and deciding on the best fit investments or ideas that you come up with and how to implement allocating there. Answer B. Question 36. DEF Investment Group invested $150 million in a private equity fund with 2.5% management fee based on end-year assets under management and a 20% incentive fee, which are calculated independently. So independently meaning we're not going to subtract out the management fee and then calculate the incentive fee. We're going to be calculating them both, calculating them independently. The fund specifies a hurdle rate of 8%. In the first year, the fund yielded a return of 15%, and in the second year, it grew by 20%. The incentive fee paid in the second year is closest to. So we have, we want to calculate the incentive fee in the second year, so we'll need to calculate first year as well. We have a return of 15, so that's going to be over the hurdle rate of 8. So we will have an incentive fee and a management fee to subtract, and then we'll calculate the incentive fee on year 2. All right, so for year 1, we're going to do management fee since it's on end year AUM, we're going to take 1.15 times the beginning year AUM to get that end year AUM, and then subtract out, and then multiply by 0.025 to get the management fee. It's a management fee of 4.3 million. Incentive fee then is going to be the beginning year AUM multiplied by the profit, essentially, and then subtracting out that hurdle rate though. So it's going to be 0.15 minus 0.08 multiplied by 150 million, and then taking 20% of that profit above the hurdle. So we get an incentive fee of 2.1 million. So now AUM at the end of the year, we're multiplying 150 by the growth, and then subtracting out all those fees. So when we subtract out all those fees, we get 166 and some change as the AUM for year 2. And then incentive fee for year 2 is going to be this return minus the hurdle rate multiplied by that starting AUM, and then you're going to multiply that by the 20% incentive, and we get 3.986 million. So we've got 2.1. We can rule out 4, which is pretty close, but we're going to be closer to answer C, 3.98 million. We'll go with that. Question 37. Based on the data provided in the following table, the cash conversion cycle of Shalek Incorporated is closest to. So let's pull in our formula here. We'll walk through this. So our cash conversion cycle in this instance is going to be days inventory plus days receivables plus days payable outstanding. And we're given days payable right here at 53 days. And then the other two we are going to have to calculate though. So for days inventory, that's going to be calculated as inventory, which we are given at 290, or average inventory. And that's going to be divided by cost of goods sold per day. So cost of goods sold, 1.8 million, and then we're just going to divide that by 365. So days inventory ends up at about 550, a little under 59 days. Days receivable is going to be this average accounts receivable number, so 430,000. Then we'll divide that by sales on credit per day, which is going to be our sales, and then credit sales is 100%. So we can just use this 3.8 million number. If it was 50%, then we'd have to adjust the sales number for that. So we get 430 divided by 3.8 million divided by 365. And we get a little over 41 days for that. Again, days payable given. So the cash conversion cycle is going to be 58 plus 41.3 minus 53. And I noticed the error I had up here. So this is supposed to be subtracting payables, not adding. So this is correct down here. We get 47.1, which is going to be closest to answer A, 47 days. Question 38. What is the most likely benefit of a corporation issuing new securities in a private placement instead of an initial public offering or IPO? So we've got A, lower cost of capital. We can rule this one out. It's going to be higher cost of capital, and that's because in a private placement, it's going to be illiquid. And so investors are typically going to require a higher rate of return, and that's going to mean higher cost of capital for the corporation. B, cheaper offering costs. That is certainly a benefit typically of a private placement over IPO. IPO is going to have significant legal, admin, investment banking costs and fees. So it's typically going to be more expensive than a private placement. Let's make sure we can rule out C, which is more liquidity for investors. We can certainly rule that out. As we mentioned in answer A, private placement is going to have less liquidity, which will be higher cost of capital. Answer B. Question 39. A 365-day year repurchase agreement, or repo, has an initial principal amount of 90 million and a redemption amount due at the maturity of 93 million. The number of days between settlement and maturity is 300. The bond equivalent yield is closest to. So this is going to be a pretty straightforward formula that we'll need to use here. Let me pull that in. So essentially what we're going to do is in this part of the equation, we're basically calculating the rate of return. So we're taking the future value or end value minus beginning value and dividing by beginning value. That's going to give you the rate of return. And then the other part of the formula is adjusting that for the number of days. So we've got 365 over 360, and then we're going to multiply that by 93 divided by 90, or minus 90 divided by 90, which gives us 4.06%, which is going to be answer B for us. Question 40. What is most likely the definition of a special purpose vehicle? A type of asset-backed security that is secured by a mortgage or collection of mortgages. We can rule this one out. SPVs are often created for this purpose, to hold asset-backed securities like mortgages or collection of mortgages, but that's not what an SPV is. It may hold different types of assets like auto loans or CLOs. It doesn't have to be mortgages, and that's not inherent in an SPV. B, a subsidiary company with an asset liability structure and legal status that makes its obligations secure even if the parent company goes bankrupt. So this is going to be correct, and is basically the definition of an SPV right here for answer B. And C, let's make sure we can rule it out. A structured financial product that pools together cash flow generating assets and repackages this asset pool into discrete tranches that can be sold to investors. Again, similar to A, this is a lot of times what an SPV is created to do. The SPV is created and then it holds pools of cash flow generating assets and repackages them into these tranches, but it's not the definition of an SPV, and it's not the only thing it can be used for. And it's the SPV is more so the legal structure, and A and C are focusing on kind of the underlying investments that legal structure might hold. Answer B.